Hello and welcome to our monthly preview for April. In these videos I give you 5 events which I think people are going to be paying very close attention to over the course of the next month and what impact they could potentially have on the financial markets. It will come as a surprise to no one that the primary driver of financial markets over the course of April is likely to be the banking crisis, or hopefully the lack of a banking crisis. Events of recent weeks have sent fear and anxiety throughout the market, scarring from 2008 still having a dominant role to play in how people are behaving in response to the collapse of a few mid-tier banks in the US and of course Credit Suisse over here in Europe. The problem that we have is that no one knows what is coming next, if anything is coming next, and that is contributing to that anxiety that we're feeling in the market. So the next few weeks there's still going to be a heavy focus on whether something is going to materialize from this, or if the dust is simply going to settle and then it's a case of what's the more permanent damage that's been caused as a result of these events. Turmoil in the banking sector is only going to add to what was already going to be a fascinating earnings season. Companies were already having to contend with a slowing economy, much higher interest rates, and now the prospect of tighter credit conditions as well. So investors are going to be paying very close attention to not only how these companies performed in the first quarter of the year, but also what their expectations are now for the rest of 2023. An earnings season kicks off with the banks themselves in the middle of the month, so you can expect that to be a driving force for how these markets are going to perform and what state these banks are in the aftermath of the turmoil of recent weeks. The US labour market has been a source of persistent strength for the US economy, and not in a way that's made the Fed's job any easier. A tight labour market makes the prospect of higher wages and therefore higher inflation all the more likely, and we need to now start seeing signs of weaknesses appearing here in order for the Fed to be able to draw an end to its tightening program and maybe even cut rates later on this year if the economy does slow, as it may do in the aftermath of the banking turmoil of the last few weeks. The jobs report for March could be much weaker than what we've seen over the course of the last couple of months. Unusually warm weather meant that we saw a very strong jobs report in January, and we saw quite mild weather as well in February, which contributed to a stronger jobs report here as well. That is likely not sustainable, so over March, April and May we are likely to see much weaker figures and signs of the US economy slowing. Another strong jobs report here though for March could make investors extremely nervous that the Fed is going to have to do more even in these volatile conditions. There's a lot of economic data that's going to be released over the course of the next month, which is going to grab investors' attention. And I think I could have picked many of these, to be quite honest, to focus in on. But it's hard to look past inflation ultimately at this point. It's remained stubborn and it's remained a source of concern for central banks around the world. So this is going to remain a key focus going into April as well. We need to see signs of inflationary pressures starting to ease in order for central banks to take their foot off the brake and allow these economies to have a chance to avoid recession, especially, as I say, in light of recent events. There's 2 inflation readings to come from the US next month. There's the CPI data and then there's the PCE inflation data. The first is released 2 weeks before the latter, which is why it draws so much focus, but the PCE data is the Fed's preferred inflation measure. If we can start to see signs of this softening, then this will allow for the Fed to potentially pause the tightening cycle at its May meeting, but more strong data from here could mean that the Fed will have to persevere with another 25 basis points, even though they are seeing signs of trouble in the banking sector and of course in credit markets as well. Volatility is back in cryptos, and with it has come plenty of intrigue, but also plenty of confusion. Events of recent weeks have seen cryptos perform extremely well, and this comes against the backdrop of turmoil in financial markets and risky assets performing quite poorly. And that has confused a lot of people, and it's understandable. And it's not just the fact that we've seen turmoil in other areas of the market, there has been turmoil in cryptocurrency markets as well. From the FTX collapse late last year to crypto-related banks collapsing earlier on in March, and then of course the issues with the regulators as well, most recently with Binance. You would think all of this negative news could have been a negative for crypto prices, but that has simply not been the case. And now people are questioning how sustainable is this rally. Now, what we can learn from the past is that Unsustainable appearing rallies in cryptos are not always unsustainable, and in fact they can actually gather pace and they can continue to accelerate higher, and that's why there's so much intrigue around the space right now. There's a strong element of confusion as to how they've rallied so strongly in such a hostile environment, but then that begs the question, how much further can they go, or are we going to see reality catch up and see the crypto prices come crashing back down to earth? I think April is going to be another very volatile and very fascinating month for this space. For more views and analysis from myself and the rest of the team, check out MarketPulse.com.